Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. On April 23, 2020, Franklin Templeton, India, stunned the financial world by abruptly shutting down 6 of its debt schemes. Over 267.79 billion rupees in investor assets were frozen, impacting more than 300,000 individuals and institutions across the country. This case raises critical questions at the heart of fund management. Was the closure a result of excessive risk-taking and poor portfolio construction, or an unavoidable response to the market chaos unleashed by the COVID-19 pandemic? The analysis explores the underlying exposure to illiquid and lower-rated securities, concentration risks, and the stress on credit markets during the liquidity crunch. It further examines regulatory oversight, the ethical responsibilities of fund managers, and the importance of transparent communication during a financial crisis. Franklin Templeton's decision sparked intense scrutiny, not only for its financial consequences, but for what it revealed about systemic vulnerabilities in India's mutual fund ecosystem. This case offers valuable lessons in risk management, investor protection, and how institutions can, or should, respond in the face of extreme market disruption. On April 23, 2020, Franklin Templeton, India, abruptly closed 6 debt schemes, affecting over 300,000 investors and freezing 267.79 billion rupees. This raises questions about whether the decision stemmed from poor risk management or was an inevitable response to unprecedented market conditions. The focus is on risk management, regulatory frameworks, ethical decision-making, and crisis response strategies in fund management. Franklin Templeton, India, abruptly froze 6 debt funds worth 267.79 billion rupees, affecting over 300,000 investors. This decision, made during India's COVID-19 lockdown, left investors unable to access their funds indefinitely, causing widespread panic among both retail and institutional investors. The COVID-19 pandemic triggered a nationwide lockdown, leading to unprecedented market conditions and economic uncertainty. Bond markets froze, creating a liquidity crunch with few buyers. Panic-driven redemption requests overwhelmed the fund's liquid cash reserves. Consequently, Franklin controversially halted all redemptions to avoid fire sales, exacerbating investor panic. Franklin Templeton's 6 frozen funds prioritized higher yields by investing heavily in lower-rated corporate bonds, particularly AA and below. These funds also held longer duration securities, increasing interest rate sensitivity. The strategy focused on yield over liquidity or credit quality, with significant sector concentration, notably in financial services. This approach heightened vulnerability to market disruptions. Franklin's funds offered higher returns from 2016 to 2019 by investing in lower-rated corporate debt. But this came with increased risk and lower liquidity. The limited secondary market trading volume heightened vulnerability to market disruptions. This raises concerns about whether such a risk-return profile was suitable for retail investors in debt funds. In early 2020, COVID-19 cases emerged in India, triggering market volatility. By March, a nationwide lockdown led to bond market freezes. Franklin funds faced over 30 billion rupees in redemption requests, prompting the closure of 6 debt schemes in April. This sparked investor protests, legal challenges, and a Securities and Exchange Board of India investigation, culminating in a Supreme Court-approved distribution plan by February 2021. Liquidity risk involves the inability to sell assets quickly without price discounts, crucial during redemption surges. Credit risk highlights potential defaults, especially in lower-rated securities. First-mover advantage benefits early redeemers, leaving late ones with losses. Mark-to-market valuation challenges arise in valuing illiquid securities amid limited market trading. COVID-19 was an unprecedented event, unaccounted for in risk models, leading to a market shutdown. All debt funds, including Franklin, faced pressure, prompting Reserve Bank of India's liquidity support. However, Franklin's higher exposure to lower-rated securities and delayed redemption gates suggest excessive risk-taking. Previous stress events like infrastructure leasing and financial services were warning signs. Yet other asset management companies managed better liquidity, avoiding similar crises. The Securities and Exchange Board of India initiated an investigation into Franklin's investment strategies and risk management. Financial penalties included 5 crore rupees on Franklin Templeton and 3 crore rupees on Chief Executive Officer Sanjay Sapri for regulatory breaches. The Securities and Exchange Board of India also introduced new stress testing requirements, liquidity thresholds, and investment restrictions for debt mutual funds to avert future crises. Franklin faced ethical dilemmas, balancing transparency with preventing panic, questioning if early communication of liquidity issues could trigger massive redemptions. The fairness of early redeemers receiving full value while later investors were locked in is debatable. Additionally, did marketing materials adequately disclose investment risks to retail investors, or were they misled by optimistic portrayals? Retail investors were severely impacted, losing access to emergency funds during the pandemic. Corporate investors faced liquidity challenges, affecting business operations. Franklin Templeton suffered reputation damage and legal costs, leading to a decline in assets under management in India. Securities and Exchange Board of India faced criticism for oversight failures, prompting regulatory changes. Investor confidence in corporate debt markets diminished, increasing risk premiums for lower-rated issuers. Risk analysis in debt funds requires balancing yield, credit quality, and liquidity. Effective crisis management involves decision-making frameworks under market stress. Regulatory frameworks must be analyzed for their role in protecting investors, ensuring oversight is robust and responsive to financial challenges. Fund managers must prioritize liquidity management alongside yield generation. Stress testing should include extreme scenarios, and early intervention is vital when liquidity declines. Transparent communication with investors is essential. For investors, higher yields entail higher risks, diversification reduces exposure, and understanding fund portfolios is crucial. The Franklin Templeton case highlights the consequences of inadequate risk management during extreme market conditions. Thank you for exploring this finance-driven case with Skilled MBA. The Skilled Master of Business Administration case series offers practical financial insights, ideal for Master of Business Administration students and finance professionals. Authored by Shagun Thukral, Deepasha Sharma, and Madhvi Sethi, this 14-page case study delves into real-world scenarios. For further inquiries, contact via mobile at +91-8 7553-00795 or email support@skilledmba.com.